I want to welcome all of our listeners to episode 18 of In Conversation with Convergence. I'm George Evans, co-founder of Convergence, and I have a terrific guest today, Reid Thomas. And Reid, if you may not know Reid is the Chief Revenue Officer of the JTC Group. Reid, how are you today? Thank you so much for joining me.
George, I'm doing great, and it's fantastic to be here. Thanks for the opportunity.
Yeah, thank you. So we've got a great topic today, ESG, and something we really haven't talked about in 18 episodes. So I want to kind of set the table for our conversation, and I think there's a few themes today relative to ESG. One is, implementing ESG doesn't need to be a burden, if you do it correctly. Second point I would make is ESG funds are specialty funds, and I think you need to think about it that way. And then thirdly, in order to be successful around ESG, you need to have the expertise. You need to have, and I'm going to let Reid talk a little bit about purpose-built technology, and you really need to have very adaptable capabilities because ESG is kind of fluid at the moment. And I think if you can check those three boxes, you'll be a very successful investor and very successful provider of ESG services. So having said that, Reid, let's kind of kick this off. I want to start the bigger picture, right? Just with fund administration, right? And then we'll work our way into ESG a little bit. But you've been around the block just like me, and trends, trends come and go, fads come and go, and I guess I would start with, if I had to ask you, what are the trends you're seeing now, in the fund administration business? What would you say those top couple are right now?
It's funny. I've been around a few blocks, George. The fund administration block. I've been around for probably the last 12 years, and it's been an interesting ride for sure. Clearly, the dominant trend right now is consolidation. I think you see that certainly from your point of view. And I find that quite interesting because it looks to me like a lot of the consolidation that's going on is really fund administrators acquiring other fund administrators to get scale. I can see that. I can see the benefits of that. At JTC, we do a little bit of that. But I think that the overarching trend is that that's happening, and maybe just so because otherwise it's kind of a race to the bottom, isn't it? I mean, how do you do it more efficiently? How do you do it more cheaply? And I'm not necessarily sure that's really thinking about what customers need and the way fund requirements are evolving. So at JTC, we're trying to do it a little smarter.
Yeah, I mean, listen, what's interesting about what you just said is, believe it or not, there are about 650 fund administrators named in SEC filings.
Wow.
And you truly do have kind of the 80-20 or maybe even the 90-10 rule.
Sure.
And I agree with you 100% about the race to the bottom.
Right.
A trend I do see that's interesting on top of what you said is people are scaling and adding capability. But they're also starting to add other services, right? We're seeing people out buying compliance companies and and managed IT and cyber, and they're trying to, some folks believe, right, that the buyer kind of has vendor fatigue, and if they want eight things, they've got to go to eight firms, and I think some of the firms are kind of pulling things together. You guys have done a nice job. I think you were very actively involved in 2021 and a majority of the acquisition activity that took place globally. And having worked with you, I think that the buying's been very smart. It's been very deliberate. But I agree with you. I think the big are getting bigger, and the small are trying to figure out how to survive, right?
Yeah.
Moving to, we talked about when we teed up ESG, we talked about specialty funds. I guess my first question for you, Reid, would be, how do you define specialty funds? And then maybe the second question would be, do you really see specialty fund admin firms, right? Or is everybody just dabbling in everything, right? What's
Yeah.
your view on that whole topic?
Well, as I said before, I've walked a few blocks in my career, a few different ones, and I grew up in the technology industry, and when we got into this space, it became apparent that all funds are not created equally, yet all fund admins apply the exact same technologies to solve the problems that their customers have. They all go out and they buy the same 3 or 4 products from the same 3 or 4 general ledger vendors, let's say, and they try to differentiate based on, hey, we have smarter people and we provide better customer service. But the reality is the clients, the fund managers, are trying to differentiate based on different things
Right.
amongst themselves. And so it's very easy to see a specialty fund that has certain different characteristics than others. Not all PE funds are created equal. Take opportunity zones as an example, right? It's a private equity fund mashed up with a tax incentive program, mashed up again with an economic development program. And so it's really those 3 things. It's not just a private equity fund. And you can find these nuances in so many different areas, be it ESG funds, be it tax advantage funds, etc. So the specialty funds are things that where the investor motivations might be a little bit different,
Yeah.
where the compliance requirements might be unique, where the customer's trying to differentiate based on a certain skill set or a certain feature or capability. There might be complex compliance and reporting needs. There might be potential for fraud and abuse, right? So how do you go into these niche markets and really deliver what the customer needs? To me, that's what specialty fund administration is all about.
Yeah, I think that's well said. Now, we talked about the sea of, 600 plus administrators. So how do 20,000 SEC registered advisors really figure out who those specialty firms are, right?
Yeah,
Who is, who's the opportunity zone, player? Who are the top ESG players? How do you
yeah.
think they wade through that sea of administrators?
Yeah, this is where it gets really hard, George, right? Because
Right.
there's a lot of noise, and I can tell you what we're trying to do. We're trying to educate and preach that there should be this category of specialty funds. You've actually started to reflect that, I think, in your league tables
We
where
have, yep.
you've done that sort of thing, and so I think it just takes time and pressure, right? It's just continuing to reinforce this messaging. We've been very successful when we're able to carve out a niche, say opportunity zones, and get in front of that market. So we've been successful when it's sort of a new thing coming on. EB5 is another category, opportunity zones. We've been able to get out in front of that and help set the narrative for the industry and educate people while they're trying to learn what these things are. And in those cases, we've been successful. It's a tougher and a bigger challenge when you start slicing off other elements, and I think you can help honestly with
Yeah, no, what's
with
interesting about the point you make is we think hard about what we call best fit for service providers, right?
the term.
So
Yeah,
we will look at the books of business of um, fund administrators and auditors and prime brokers and
right.
custodians, and we'll see what kind of book of business they have. I mean, one of the things we're doing right now on the digital side, right, is we're painting a picture for advisors as to who are the top 20 fund admins servicing
Right.
digital, right?
Yeah.
And it's no different for ESG. So
Yeah.
so so back to ESG. Let's talk about, your kind of view on the state of the ESG investment industry. I'm interested in your thoughts, really, kind of the state of the union of this right now.
Well, the State of the Union, somebody said to me the other day, there's been something like $14 trillion reportedly invested into ESG funds and ESG initiatives, right? And they said, well, if that was true, then we really wouldn't have any of the problems we have, would we?
Right.
So,
Sounds overstated.
yeah, exactly right. I think the state of the industry is that there's just really a lack of definition around what is truly and making a difference in terms of an ESG investment. There's a lot of demand for it from investors, I think. There's a lot of demand from it from sort of social good, but how to report it, how to measure it, All of those types of things are just not where they need to be at the moment. And so therefore you have these huge numbers being thrown around as being invested in it, but without any real results. While the truth is there are a lot of really, really great ESG and impact-oriented funds and investments going on out there that are getting lost in all this other noise.
Yeah, I mean, and do you think why do you think it's playing out that way, Reed? I mean, do you think it's playing out that way because it's just new? Right? I remember back to SPACs, and I
Yeah,
remember something. Well, why do you think? Because I agree with you. I think the investors are being clearer than ever about moving in this direction, right?
yeah.
So why do you think on the service provider side it's playing out the way it is?
Well, there's just too many different frameworks. There's too many different reporting methodologies. There are over 250 software companies out there that claim to have ESG reporting software packages. Okay,
Mhm.
and that's just the wrong approach. Everybody's idea about what is good is different, and investors have different passions at the end of the day, right? So, it when you want to make an investment in something, what I've seen is certain investors might be passionate about mental health. Other investors might be passionate about carbon emissions and all of these things. And so that's where the rubber's really meeting the road. Is
Yeah.
there are very specific funds that are out there targeting to do very good things that some people are passionate about. And when you roll it up into all of these big frameworks and ESG scoring methodologies, all of that gets lost, right? And so that sort of leads into, well, if there's these sort of point-oriented funds that are really doing good, how can you cost effectively deploy sort of ESG metrics and measurement and monitoring? And that sort of gets into specialty fund administration and purpose-built technology and some of the themes you talked about before.
Yeah, I mean, I think that's right because when you put it like that, you think about, there's a larger burden, right, being put on everybody in the game because of all these special requirements, and I think you do have to, when we go right back to the themes, I think you have to talk about purpose-built technology. I think you have to be pretty adaptable, right? It's not a long short equity hedge fund, right? Which is
Correct.
right?
Correct.
And so I think it's still evolving, and I think administrators are really going to have to decide, whether they're going to truly make an investment to be flexible enough on these varied requirements. To your point, right?
Yeah,
Um,
exactly right. Yeah.
yeah. All right. So moving, I want to talk a little bit about let's stay on ESG and I just want to talk about the future of ESG funds, right? And so your views on the future, um, and secondly, hey, Reed, you've been, you service a lot of sophisticated managers. What would you guys say to a manager who's just getting started, in ESG?
Yeah, I think the right approach here is to think about it from the admin perspective itself. If this isn't going to be a burden, you want to be able to start to report, measure the impact the ESG fund is actually having based on information you're processing anyway. I mean, that's where we started from. Many of the economic models that are done in the federal government, as an example, are really extrapolations, like how many jobs are going to be created, how many indirect induced jobs, all of those kinds of things are derived from expenditures. Well, at its core, fund administration, fund accounting is tracking these kinds of expenditures, right?
Yeah.
So it sort of starts from there, and that's where the big gap is, right? So, these companies that come along with these third-party software and reporting packages, well, they can't do anything without that core data. Fund administrators have that data, so build out from there. So to me, to your question, that's how I would advise those folks is, okay, let's start from the basic accounting that we're doing, and what can we derive from that's ESG and impact oriented. And those kind of things can be heavily automated. And so you can do it at a very low burden. But the other thing I said is, remember, there's different passions out there, right? So there's always something unique. So you have to have the ability to customize other things you're tracking. One of our clients is focused on recidivism, as an example, which is, convicted felons coming back into the workforce and getting trained and trying to measure, are they successful in merging into the workforce, or are they back in prison again, right? And so that's a passion that they have.
Yeah.
Can't derive that from the accounting data, but
Right.
you have to have some way to tell that story and measure it. And so to me, it starts from accounting and then builds out, not from, okay, I'm going to get a third-party consulting firm to come in here, send out a bunch of questionnaires, answer a bunch of questions, and report data that's 2 years old. Instead, we're going to do it on a quarterly basis, just like we're doing with the accounting data, and
Yeah.
report this as we go. And then your investors can monitor and measure and get excited about the difference that they're making by investing in these funds. And it's sitting right alongside the yields and the return they're getting, right, which is also important. And so then you can use that data in a much more real-time way, George.
Yeah, and it plays into one of a little bit. Maybe you could expound on this a little bit. One of the questions I was going to ask you is, how is data management? How is data science kind of? It becomes very critical at a place like JTC.
Yes.
Given what you just said, I'd like to hear your thoughts on that, maybe a little amplified.
Yeah. Well, data. This is what where it gets what it's all about, right? Is there is just massive amounts of data involved with this, and there's multiple sources of that data. There's publicly available data that you can get from sort of census data, right? If you want to know the makeup of a community, you can pull that sort of information. There's publicly available data that'll tell you what's the education level, the poverty level, all of those things in that community. There's questionnaires and surveys that you can send out, and then there's the accounting data that you also have, right? So there's multiple sources of data that need to be aggregated, and then there's multiple places that data needs to be massaged and pushed to. And so there are technologies good at that. We spun off a company called Harmonate, which you may be familiar with,
Yeah.
which is a data aggregation company that's really good at pulling data from disparate sources, aggregating it up, and then pushing it back into our fund administration solutions so we can do reporting much more efficiently. But there's technologies out there that do this type of stuff, but that's the big issue.
Yeah, and we talked right at the beginning about one of their themes, and that's I'll mention it again, expertise, right?
Yeah,
Because listen, that's how we think here at Convergence, that the data we put out there, the expertise is what gives it color. The
right,
expertise is what gives it meaning,
right,
right? And
right.
and if you're going to create derivative data off of data, well, you got to understand the data to do that, right? And so when we put our data out there, we're all about the meaning, right? The color, the meaning, not just the data. And I think
Yeah,
there's some parallels to what you
right,
just right. Um,
absolutely.
all right. So listen. Lastly, it's hard to believe I'm going to ask you this question because it's August, the end of August, right? But as I'm starting to see people already talking about 23 and planning for 23 and budgets and objectives and goals. Um, Curious what your thinking is. As JTC wraps up this year. And you look out to the 23, what you could share with us for some of your bigger plans might be, and then the flip side, what do you think some of the challenges are that you're going to face out there in the market?
Yeah, well, JTC is great. We were NES Financial, where I originally came from, was acquired almost 3 years ago now, and JTC is just a fantastic company. We have so many capabilities across our footprint. We're, I think, uniquely positioned in that we have a private client business. Maybe not 100% unique, but I think it's becoming rarer, where you have a company like ours that is a private client business and an administration business. And then under that, you have all of these different capabilities. We have trust capabilities, right? We have, we just bought a company called Sally in Texas that's focused on another specialty fund category. We just have many, many of these capabilities. So for us, it's really about how do we harness all of those capabilities and develop solutions for our clients that's going to be the big deal, the big win for us in 2023. We're going to continue to make strategic acquisitions here and there, but we're putting things together. Like we bought Perform Due Diligence, so we have an operational due diligence company, right? So how can we take that, bundle that with some private client services, bundle that with some escrow and admin services, and create a unique solution to our clients? So that's what we're doing. And you see ESG is a great category for that, between the data collection, the expertise, the AFIM, SFDR, UNPRI, compliance reporting, all of these things putting together to deliver solutions to really drive growth. That's what we're really focused on.
Yeah, I mean, the integration's key, right? And you see varying levels of it out there from the acquirers, right? And what I think what the buyer wants is somebody to bring a set of capabilities holistically to them, right?
Exactly right.
All right, well, how about on the challenge side? If I had to ask you a last question, like, what are you thinking, you face out there? What are the headwinds?
The same as everybody else does. There's macroeconomic things that are going on. There's political things that are going on that are getting in the way, and I think those are the same challenges everybody else faces. So the key there is, how flexible, adaptable, how quickly can you move, and that's where, back to my technology core. That's wired in our DNA, right? We built our own purpose-built technology to be able to fill those gaps that exist in the marketplace and adapt. Sure, we use third-party products, best-of-breed technologies as well, but our own secret sauce is what ties it all together to bring solutions to the marketplace. So we like to think we're more adaptable, flexible, responsive than probably what our competition can be, subject to these macro environment shifts.
Yeah, well, great. Listen, I think this was a great conversation, and it's been a great year for you guys, and I very much, enjoyed our conversation. And you've also been a great long-term client of Convergence, so we thank you for that.
We appreciate your service. It's very valuable. We love the data, and look forward to continuing to work together.
All right. Well, listen, I want to thank our listeners today for joining me and with Chief Revenue Officer of the JTC Group, Reid Thomas. I appreciate your time, Reid, and I thought it was a fantastic conversation. So thank you very much.
Thank you, George.
So again, thank you, Reid, and I want to just turn to a few monthly comments on our league tables. As you know, we do league tables for fund administrators, the audit world, prime brokers, and custodians. And I'm looking at July 21 to July 22, and we're going to take a look at fund growth in those four markets. So let me start with fund administration. We saw funds grow about 11%. And what's very interesting is we saw fund growth in the top 5 administrators at almost 22%, so almost double the market. When I looked at admins 6 to 10, they grew about 9%, so a little under market growth, but close. But admins 11 to 25 grew at 20%, very similar to 1 to 5, so almost double the market. We saw all other admins not grow and shrunk about 5% on the fund side. And then the self-administered market grew at about 6%. So it's an interesting distribution, with the top 5 doing very well, 11 to 25 doing very well, 6 to 10 kind of keeping pace with the market. On the audit front, we saw that same growth, about 11%, and the big 4 grew at about 7%. But what's interesting, very interesting in this market, is auditors 5 to 10 grew at 25%, so more than double the market, and auditors 11 to 25 grew at over 30%. So we are clearly seeing funds being awarded to audit firms 5 through 25 at a much bigger and faster pace than we're seeing in the top 4. When I go to prime brokers, we saw about that same growth, about 11%. And it's a much more even distribution in the prime broker market. We saw primes 1 through 10 grow at about 4.5%, 11 to 25 grow at about 7%, and then all other primes grow at 10%. So what that kind of shows you is the market is going down market to prime 26 plus, right? At a almost a double the rate that they're giving those new funds um, to the top 25 prime brokers. And then lastly, on the custody side, again, that same growth of around 11%. We saw custodians 1 through 10 grow at just about that same pace, 10%. Interesting though, custodians 11 to 25 uh, grew it did not grow and actually shrunk about 3%. And then all other custodians grew at about 8%. So when you look at that growth in the custody market, you know, the 1 through 10 keeping very much pace with the market. All other custodians, 26 plus, fairly close to market growth, but custodians 11 through 25 very much trailing market growth. So interesting shifts, interesting changes in the leaderboard every month. And we'll keep talking about this. If you're a client of Convergence, you obviously get these league tables. If you're not a client, we certainly would like to talk to you about that. I want to thank you all for joining us today. Again, I want to thank Reid Thomas for the JTC Group, and a great August. Summer went too fast. I don't know what you thought. I did, and I look forward to seeing everybody in September. Thanks, and have a great day.